I'm live from our studio in New York. Here's what we're watching this afternoon. Markets are mixed an hour from the closing bell on Wall Street. The Dow is the standout, jumping more than 300 points, hitting its highest level of the year. Despite declines today, the S&P 500 and the Nasdaq are still heading for their best monthly performances in over a year.
Meantime, Elon Musk about to hit the stage for the Cybertruck delivery event. It's been 4 years since Musk first unveiled the truck, and the EV maker has faced plenty of hurdles and production delays trying to get the Cybertruck on the road. We will be following the latest developments and bring you updates.
And mortgage rates extending their decline. The average 30-year fix now at 7.22%, now down 5 weeks in a row. The news coming after pending home sales fell to their lowest level since 2001 last month. That means sales are even worse than during the financial crisis. All right, let's get you up to speed on all the market action here. Major averages are mixed right now. Listen, we've been in rally mode, but now bulls having a hard time here gaining some ground. If you look at the equity markets, S&P 500, that is basically flat. The tech-heavy Nasdaq edging lower there. Now, the Dow, a different story. There we do see some green. Of course, that index is getting a lift today from Salesforce, which reported results. Investors liked what they heard, and they piled into Mark Benioff's company. Take a look at Treasuries as well here, which, listen, they've been rallying as well. But today, we do see, as you can see there, yields rising. We did get economic data today showing consumer spending and inflation cooling, adding to this conviction that the Fed is done hiking and that cuts are in the pipeline. And that, of course, is what's helped drive this rally in the equity markets. But now we are churning here. Still worth pointing out, of course, the S&P is on track for one of its biggest November gains on record, Diane.
And a big story today, Josh. The hotly anticipated Cybertruck. The first deliveries are scheduled for today, and Tesla is at this moment. It's hosting a launch event at its headquarters in Austin, Texas. So we've been following the story. You're looking at right now images of the Cybertruck and all the hoopla around it. We've been talking about this. I mean, Elon Musk has been in the headlines all week, honestly, for a variety of reasons. Today, the big headline, obviously, the Cybertruck. And I mean, it's been delay after delay, Josh, but it is here. It's arriving. We know there are about 1 million people who have made reservations for this vehicle. It's interesting to see what the dynamic is of the people who have decided that this is the truck for them, because it's different than your normal truck, like, say, when you compare it to an F-150 or the Ram.
Yeah. I mean, we were talking before, Diane, about how I don't think I've ever seen a vehicle that has created this much emotional response. Yes. I mean, people have very strong feelings about this truck.
Right. They do. Visceral reactions, including myself.
Visceral is the word, yeah.
No,
I mean, I'm thinking of buying one just because I feel like it would just frustrate and irritate Julie Hyman that much. I feel like that's reason alone put it down $50,000.
I'm with Julie on this. I'm not a fan of it. I mean, because it's not just the futuristic look of the truck. It's just so different than your typical, like we just talked about, the F-150 or the Ram. And one of the questions is the utility of this vehicle. So obviously, it's a looker in different ways, so it is going to elicit a reaction whether you're in or you're out of this. It reminds me of the Bronco when it came back, in the sense, I mean, very different look, obviously, but it creates a very visceral reaction. So it's going to have a smaller appeal than, say, the F-150 or Ram. It may widen over the years. We'll see.
Yeah. I mean, issues there. We're going to hear today about pricing, I think. Is
Yes, that's the biggest thing.
Yeah, for sure. Waiting for clarity on that. Moving on here, Treasury yields jumping today off the back of inflation data that showed further cooling in the market. The PCE price index increased less than 0.1%, boosting sentiment on Wall Street that the Fed will continue to hold rates steady. Here with a deeper dive on this is Rob Hayworth, U.S. Bank Wealth Management's Senior Investment Strategist. Rob, thank you so much for joining us today. Listen, we did get a lot of important economic data today, Rob. So consumer spending, inflation seems to be showing some cooling, adding this conviction, Rob, that, listen, Jay Powell and our central bankers are done hiking, that cuts are in the pipeline. Is that your view, Rob?
Yeah, no, thanks for having me. So our view is the Fed's probably on hold into the middle of the year. I think the key is still how the data evolves, right? Even though we saw inflation slow a little bit more, I think the challenge is it's still somewhat elevated, and we really need those shelter costs to come down and some more signs that the labor market is slowing. We're getting some, but it's not slowing very quickly. So I think we need a lot more data for the Fed to really feel comfortable before they maybe consider cuts maybe at the middle of next year, but it's going to take some time and a lot more data.
So speaking of the data and the PCE data that came out today, it does show that it seems to be that we're on the right track. How do you think the Fed reads this, Rob?
No, I think they definitely read it as on the right track. I think as we get into December, our expectations would be they don't need to make a change here in December. And obviously, after the December 13th meeting, we'll all be paying close attention to what they say, as well as their dot plots and how they think the economy evolves. But for now, the market's thinking it's 4 cuts in 2024. That seems a little aggressive based on what we know so far for economic data, which has been surprisingly strong if we think about 2023, and it will take an awful lot of cooling, maybe a recession, to get the Fed to start to move towards cuts later next year, which is not necessarily great news. And by the way, I should be clear, not really our base case. We think we can narrowly avoid a recession next year.
So Rob, you seem to be implying that you're in the soft landing camp there for 2024. You think inflation returns that 2% target without a downturn?
Yeah, I mean, for now, and this is really coming from our economics team at U.S. Bank, which does a fabulous job evaluating the consumer. The consumer remains surprisingly resilient. I think even if we look at the personal consumption expenditure data that just came out, their spending is holding up okay. Yes, they're still preferring services over goods, but we're not faltering too badly yet, even though we did see the start of student loan repayments. Yes, mortgage rates are still elevated. Housing activity is a little slower, but the consumer seems to be able to weather this storm for now, and we may be able to move through this without a lot of damage to the economy.
Rob, I want to pivot a little bit from the economy to equities and get your take on where things stand now in terms of the market movement, some of this FOMO trade that seems to be happening. What is your view on what's happening? Is it a catch-up trade?
Well, there's certainly been some of that. If we take a look at smaller companies, at utilities here lately, as we look at it and we look at the broad S&P 500, we think we're still in what we've termed the chop, right? This is a market that is really looking for direction one way or the other, whether it is recession, it is Fed rate cuts on the horizon, or are we past this earnings recession and earnings are really going to be quite strong headed into 2024. So we're seeing the S&P 500 is kind of bound between, say, 4,150 on the low end and 4,600 on the upper end. And until we get out of that range, I think it's a lot of uncertainty and back and forth. I'm sorry, go ahead.
No, go ahead, Rob.
Oh, yeah, no, I think as we look at it, there's certainly some value that's arisen in the market as we take a look into 2024. We've seen utilities, defensive companies, financials, healthcare, a lot of sectors outside of those growth sectors like technology and communication services, which have been left behind and may have some catch up to do in 2024. But it's hard in the long term to really discount those growth-oriented companies because this is an economy where fast is getting faster. Artificial intelligence, cloud computing, software, data security are all major factors as we think about spending moving forward over the next 2 or 3 years.
And Rob, you're also a fan of oil here?
Well, it's something we're really considering as we look ahead. I think the challenge for oil is global demand. We really need global trade to kind of rebound. And that soft data coming out of China and Europe is not good news for global trade just yet, nor for global oil demand. But as we get through this winter season, there's a lot of support to think about when it comes to oil, particularly because inventories here in the U.S. remain low. And we're not necessarily positioned to meet that ramping demand should the economy start to improve.
And then what are the catalysts that you're looking for to really be off to the races in terms of the economy that changes kind of your perspective on where equities are and where they're headed in 2024?
Yeah, great question. I think if we can get past this inflationary pressure and get kind of back to a normal economy, that will help. That means, we kind of work through I mean, it's kind of unusual to think about a soft landing without a recession because you don't get that sharp rebound like we saw in 2021 after the 2020 pandemic recession. But right, we can get an economy that starts to really recover if we get through some of these headwinds and get back to kind of a more normal supply environment, which means we have enough labor. Right, people are certainly seeing higher wages, and that can kind of support better economic activity as we move forward.
All right, Rob Hayworth, great conversation. U.S. Bank Wealth Management. We appreciate your time.
Thank you.
Got it. All right, let's take a look at some tickers that we're watching today. Shares of Snap trading higher, up more than 6%. The stock getting a pop on an upgrade to a buy from Jefferies. Jefferies added it to its list, saying that, they've made a couple calls today. They look at Snap as one of their more controversial calls that they're making with regard to that. But they say, look, there's increasing optimism around the recovery within that sector. And they say that the most challenging times for the company seems to be over. And so they see a pathway back to mid-teens revenue for Snap. So it's interesting to see this, and we're certainly seeing a positive reaction within the market today. Early signs of DR-driven turnaround in their notes. They pointed to last quarter's growth, the fastest growth since Q3 of 2020. So that stood out to me, Josh, with regard to Snap's performance today.
Yeah, it's interesting. The team at Jefferies says, listen, that they recognize that what they say, this is a controversial call, right? They do, but listen, they take their target to 16. Most on the street are not bulled up on this name, though, by the way. Most are at a hold. And the stock, though, listen, it has enjoyed a big run this year. You're up now more than 50%. By the way, Pinterest, as you mentioned, they upgrade that one as well. Based on what they say is an increase in conviction in its ability to grow revenue, 20% in 24. Target there goes to 41. Also, nice year there, about a 40% surge so far for Pinterest.
Yeah, and then with regard to Snap, they say that the setup to the year end looks compelling. They believe that the internal Q4 forecast that it gave was actually conservative. So again, the optimism around it. But to your point about the target that they have on the stock, that's a double-digit premium right now. So, so you're seeing, yes, a positive reaction today, but will it get to the level that Jeffrey sees? We'll see.
All right. Moving on to the proxy battle at Disney. Activist investor Nelson Peltz says Disney rejected his request to be on the board. Now Peltz's Trian Fund Management is taking its case directly to the shareholders. Trian owns approximately $3 billion worth of Disney stock. So our own Allie Canal, by the way, has a write-up on this one, which is a good write-up and worth reading. Trian saying that Disney extended an offer to meet with the board, but turned down its request for representation, including for Mr. Peltz himself. Yeah. So here's where we're at. So the firm says, okay, we're going to just take our case directly to shareholders. Trian saying in a statement here, investor confidence is low, key strategic questions loom, and even Disney's CEO, they say, is acknowledging that the company's challenges are greater than previously believed.
Yeah, and it's interesting to see this also coming after changes to the board makeup with, we've got James Gorman, the former CEO of Morgan Stanley, coming alongside the board, or alongside Disney's board. So it's interesting to see, and not surprised though to see Nelson Peltz. He's known to be an activist investor. Not surprised to see him pursuing this. But Disney has had a lot of challenges this year, and we know that Iger had to come back to kind of change things up and right the ship, if you will. And Disney's stock has really suffered since, with all the challenges they've had. The parks business has been slow. Their film business has faced challenges as well this year, especially amid the strikes. And finally, a pharmaceutical company we're watching, AbbVie, is going to buy cancer biotech Immunogen, which is seeing a big spike in the share price today. The acquisition said to be $10 billion. Shares of Immunogen up over 80% on the news. And interestingly enough, AbbVie has been ticking higher, a little bit higher, up 2%, which, Josh, you and I have been in the business long enough to know that often the buyer usually gets a haircut on the day of an announcement like that. So it's interesting to see. Not surprised to see Immunogen doing so well in terms of its share price. AbbVie, we know, is trying to get a piece of the cancer treatment space with this deal. So that would give it, just some, I guess, wiggle room in terms of just the issues that they're having in terms of the competition for Humira, which is, has some competition from the generic space as well. So
yeah, and I thought Bloomberg did an interesting job, Diana, also just kind of talking about the bigger, broader picture here, where they know, drug makers' demand for these kinds of treatments that attack cancer cells with, I guess, minimal damage to kind of surrounding healthy tissue. That's been in demand here. They note Pfizer's purchase of Seagen announced back in March, same strategy. The team at BMO noting the trend, saying we see the deal as a positive for biotech as it reflects our view that quality oncology assets are of high interest to large pharma, and they argue merit a premium.
Yeah, indeed.
All right. Well, we are just getting started here on Yahoo Finance Live. Coming up, OPEC Plus oil producers agreeing to voluntary output cuts at a meeting today. We're going to check in on oil prices since that decision. And Ulta's Q3 earnings report out after the bell. We're going to break down the numbers and get you in-depth analysis. And Yahoo Finance launches Lead the Way, our new video series that features the GOATs of Wall Street. Our interview with Abercrombie & Fitch CEO Fran Horowitz on the other side of this break.
Today, we are launching a new series at Yahoo Finance, Lead This Way, where we talk with some of the titans of industry about their biggest challenges and how they are leading through them.
Yahoo Finance executive editor Brian Sozzi recently met up with Abercrombie & Fitch CEO Fran Horowitz in New York City.
All right, over the past 6 years, Fran Horowitz has rebuilt a mall apparel icon in Abercrombie & Fitch that fell on hard times under prior leadership. She shared with me her turnaround playbook and how she leads with authenticity inside a newly opened Abercrombie & Fitch store in New York City. This is Fifth Avenue, the mecca of retail, and here's Abercrombie & Fitch. Back in New York City?
Probably the proudest moment of my career. No one said it could be done.
So how do you become a successful turnaround CEO? You lead with compassion, you lead with hustle, you lead with empathy. You take all those terms together and you get Abercrombie & Fitch CEO Fran Horowitz. Going back to those early days, working in a retail store in high school, are there lessons you learned back then that set you up to do things like this?
The biggest impression in my career was at Bloomingdale's. Mike Gould was CEO, Frank Doroff was my GMM, and they were the most authentic, people-oriented managers. I, to this day, am fortunate to think that that's really where the best part of my career started, because they taught me how to lead. And I lead now through authenticity.
What does leading with authenticity mean?
It's going to sound kind of crazy, but you have to be you. And perhaps that isn't what a person can give, but I leave it all out there. I mean, I'm very approachable, I'm very real. I go to the cafe every day, and make sure I get coffee and chit chat with everybody while they're online. Our meetings are very inclusive of all the levels in the organization, and those are honestly things that I learned really early on in my career and have taken with me all the way through. And when we're at work, I admit when I'm wrong. And it's one of the funnest things I do with the team, because I'll challenge, I'll disagree, and then I'll say, when we come back to the follow-up meeting, I want to know if I was wrong, tell me I was wrong. And we've gotten to a place where they will tell me, and that's great. And if I'm right, that's okay too sometimes.
How do you deal with that? How do you deal with that feedback when it's not positive?
You have to smile and take it just like as if it was positive. Then you have to say, okay, what was the lesson learned? What didn't I see? How come I didn't see it the way you saw it? What information did you have perhaps that I wasn't thinking about? And then it becomes a really great dialogue between you and the associate, because you're really trying to probe and understand perhaps what you didn't see, or vice versa, what they didn't see.
What were your first big moves at the company?
When I shopped the malls way back in 2014, and I saw Abercrombie and Hollister, they were essentially the same brand with the same product with a different nameplate and a different price tag. And it was a precarious time. I mean, the brands were not loved. The business was in a downward spiral. We went through a lot of starts and stops, but what we knew through the whole thing was there was an affinity and a love for the brand, and consumer insights that kept telling us, keep going, you're going to get this and you're going to figure it out. And then pivoting the team and the company from telling the customer what they wanted to hearing what the customer wanted and providing that for them. You walked into our stores and it was about presentation and how the store looked. You don't have to smell it, 6 blocks down before you get to the store, very candidly. Now it's about how's the customer experience? What's important to the consumer? How are we making sure that we're pleasing them every time they shop with us?
What is your turnaround playbook? Because driving a turnaround for a brand that has had a lot of ups and downs since its founding, 1892?
1892.
And that's not easy stuff.
No, it's not. There's a couple of lessons learned. So I went through this experience prior at Express. So I would say that turning that brought with me some good lessons. The number one lesson that I brought with me was patience and timing. And to think that you can do it all at once, you're going to burn out your team, and they're not even going to be here to do it for you. So that was a big, important lesson for me. So I feel like when I got to Abercrombie, I just knew I had to pace it differently. I think building the team is also incredibly important, because we had a lot of long-term associates, many of whom are still with us, and we have new thinking. And bringing those two together is one of my proudest moments. I've built a team that actually has some of the original thinkers as well as some new thinkers, and that brought together some incredible energy. And lastly, make a mistake. And when you make the mistake, just fix it and move on. But if you wait until you think everything is perfect and ready to go, you're going to stand still, you're not going to get anywhere. But I will tell you, the company was at quite an inflection point. And with between the business, the profitability, and all the things that were swirling around. I mean, the first 2 years were extraordinarily challenging.
Fran, looking back, what would you tell your former self?
I think what's very important as you go through your career is to learn how to advocate for yourself. And it's not an easy thing to do because you have to balance between being humble and being proud of what you've accomplished. But I would tell you, as I've progressed and built confidence through my career, I've learned more and more that advocating for yourself is a very important thing to do. If you believe that people know what you're doing and what you're succeeding in, you most times not. And so that would be my best advice to give to someone, which would be to advocate for yourself.
Lastly, put the notes aside, Fran.
Okay.
What do you think will be your legacy in retail or in life?
I guess what I would hope for is that my legacy would be a leader that people really enjoyed working for. Someone who brought them inspiration, happiness, taught them a lot along the way, had them take away good lessons from all of that. But I think leadership would be my most important thing that would make me the happiest.
All right, Sazi, so fantastic job as always, my friend.
Appreciate it.
Let me ask you, when you talk to Fran Horowitz, what's your sense of where she's taking this company next? Where is Abercrombie & Fitch headed from here?
Well, quick backstory. I've probably known Fran 5 years, and she really came back and joined Abercrombie really at one of its low points in its history. I mean, there was massive turmoil inside this company at headquarters, in the stores. Nobody was really buying the merchandise. It was completely out of style. So it has taken time for her to get this point, and even to come to do an interview like this has taken time because she finally has results to back it up. Really, three key ingredients, I think, here underpin this turnaround. One is culture. Fran and her team have worked very hard to reset the culture inside the company, whether it's the headquarters or in the stores. One of her first moves when she joined Abercrombie & Fitch was to stop spraying cologne throughout all Abercrombie stores and encourage associates turn back on the lights. Keep in mind, Abercrombie & Fitch 15 years ago, you walk in, it felt like a dance club. So really resetting the culture started at the store level. Number two, back to retail basics. You go into these Abercrombie & Fitch stores and Hollister stores, and you're compelled to buy something, even if you're over the age of 25, me included. I have bought something recently at Abercrombie & Fitch. I have not aged out, very important. And I think we saw it in the most recent Abercrombie earnings results about 2 weeks ago. And then last but not least, this is a company that has leaned into social media. They now have almost, I believe, 100,000 followers on TikTok. They're aggressive on social media, aggressive getting their new message and their new marketing and their new clothing out to the next generation of shoppers, and the results are starting to prove out. And the stock up 250% in the past year.
Yeah, to your point, it's to use an overused phrase. It reminds me of that phrase, don't call it a comeback, because I remember when Abercrombie & Fitch was huge and then they lost their luster and then now they're staging this comeback. There were several things that stood out to me in that interview that you did with Fran. It was a great interview, by the way, but the owning your mistakes, you make a mistake and you move on. It's just, it's a great mindset. And then the talk about perfection, and I've heard this phrase before, don't let perfection be the enemy of progress. So what was it that stood out to you about how she leads?
Well, I think I was really reminded in doing this, and for me personally, this is the thread that is going to tie all of these interviews for Lead This Way, at least season 1, together. There's more underneath the numbers than just numbers and spreadsheets and Google Docs. There are human beings, and these human beings, whether they are a CEO, CFO, CMO, whatever it is, or the people at the store level, in the case of Abercrombie, they're the ones getting it done. And it's the CEO's job to set that tone and lead by example. And I think Fran has done that, whether it's her eating lunch in the cafeteria with employees, whether it's her walking tons of stores every single month. She is very forward-looking, forward-facing. She interacts with employees, and I think that's very key. And she truly believes in what she's trying to do. Now, not to sound Pollyannish, results might slow in next year, who knows? But she has driven a very, very good comeback, and the stock market has finally started to realize that.
All right, Executive Editor Brian Sazi, thank you so much
Appreciate it.
for
Thank you.
launching Lead This Way.
Thank you.
All right, to dive into what it takes to turn around a retail company in this day and age and the state of the retail space, we want to turn now to Storch Advisor CEO Jerry Storch, along with Simeon Siegel, BMO Capital Markets Managing Director and Senior Analyst. Jerry, I want to start with you with this. Fran Horowitz of Abercrombie & Fitch is taking the credit for turning around the retailer. What is your take, Jerry?
Well, she just heard it you just heard from her. She explained what she did. The most important thing is that passionate focus on the customer. At the end of the day, that's what every business is about, big or small. Any business is about the customer. So she saw that the merchandise wasn't right for the customer. It had been horribly stale, and she fixed it. She saw that the two brands that they had, were basically offering the same thing, and she differentiated it. I mean, it's still very young. I don't know. I heard some people there didn't age out. I aged out a long time ago from either of them. But some are for teens and some are for older teens or young adults. But it's very clear who the customer is, and she's passionate about making sure that's what she's offering them. So, and the final thing she did, she brought the brands back into the mainstream. They had gotten so weird, kind of almost edgy, that the market was tiny for what they were selling. And now it's something that everyone in those target segments can be excited about. So she's a consummate merchant, which is all about details, all about passion. She did a very good job. And I'm sure, as long as she's there, they're going to keep doing it.
And Simeon, I want to bring you in here as well. Listen, you cover the industry, you cover the name, Simeon. Nobody knows retail better. How common or how rare is it, Simeon, for a retailer to be able to turn itself around the way Horowitz turned around this particular brand?
Can you see that I'm blushing from? I don't know how the lighting works. Good to see you guys. Listen, it's not common, but it's not. I mean, it's not doable. I think there's a thought here. It's very hard to kill a retailer. I think that there's a notion that if you can know your customer, Jerry put it perfectly. If you know who it is that you're trying to sell to, then at the end of the day, if you're willing to forego what the identity was in the past, you have the distribution. You have brand awareness. I think you start with a great foundation that even if you have to change and remodel a little bit of the store, you can do that. So is it very common to watch a business go like this? Well, it happens to retail all the time. I think what's really interesting about it right now is it's working through that teen space, which tends to be so fickle.
And Jerry, switching gears here a bit, Fran may be the CEO of a multi-billion-dollar retail company, Jerry, but what lessons can small business take from her turnaround story and your insights as well as a former retail exec yourself?
Well, honestly, it's the same. It doesn't really matter how big the company is. The challenge is similar. And it's not easier just because it's smaller either. At the end of the day, it's still starting with the customer. What do they want and how do I give it to them? And, we all talk about how great store environments can be or not be, and that's important. But really, what does a retailer do? Except the place you go to buy something, once you've left, you've left. So what did you get? Is it what you were looking for? Is it something that was worth more than what you paid? That's what retailers do. And so a good retailer can do that. If you stay focused on, it sounds, again, I'm saying it a third time, stay focused on the customer, then you can succeed. It is a million details, though. It is an enormous amount of energy. And you can see that in Fran, right? In running one of these retailers. And it's what that also means, though, it's unusual maybe in business, but one or two great leaders really can do what it takes in terms of lifting it up and building the team that it takes in order to drive the business. You can make a huge amount of difference just by kind of I used to use the metaphor of taking a big syringe full of adrenaline, shoving it into the into the tail end of an elephant. You really can move it. It's a business with a very short cycle time compared to pharmaceutical industry or something like that, where you can make a difference if you have high energy and are focused.
So, Jerry, this is a crucial time of year for retailers, and we just got data in that we've looked at with regard to Cyber Monday, and then before that, Black Friday. We saw $9.8 billion in sales on Black Friday, more than $12 billion for Cyber Monday. But what retailers are best positioned as we look ahead during the rest of this holiday season?
The first thing I want to say is be careful with those numbers. You can't take the Adobe numbers out of context and project what's going on in retail. Those are only e-commerce numbers. And most of the numbers they've quoted are just totally consistent with the year of growth that e-commerce has had all along, because e-commerce is taking share. We're not so sure what's happening in bricks and mortar retailing. From what I've heard, a lot of what we saw in the growth on the internet was at the expense of bricks and mortar. So be careful. It may not be that astounding a holiday season as people are screaming record numbers on Black Friday, all of that, not so clear. Given that environment, I still think the winners are those that provide tremendous value. Walmart has done great. I think they're performing as well as I've ever seen them perform. Their position in the area the consumer is focused on, which is, closer in necessities, groceries, things like that. They're going to continue to do fantastic. Costco continues to perform at a very high level. TJX, Yeah, very high level, excellent company, numbers that are fantastic. And then, of course, Amazon, because that internet is growing and they are clearly the best on the internet. Meanwhile, retailer after retailer, the other guys, they're reporting big negative numbers. Sometimes the stock has seen a surge, like we've seen that recently with some companies that showed higher earnings than expected. But look at the sales: Best Buy -7, Lowe's -7, Nordstrom's -7 same-store sales, Macy's -7, Kohl's down 6, Target down 5, Home Depot down 4. There is a lot of carnage out there on the top line for sure in retailers right now, because consumer is not open up their wallet and buying like crazy.
And Simeon, when you look at your coverage universe, get you in here too, who are some of the winners and losers in retail, looking ahead, Simeon? Break it down for us. Discounters, luxury, athletic gear. What do you see?
Josh, loving you bring me back in. I'm keeping notes on the things that I wanted to catch up on. One, I wanted to point out that retail is all about storytelling. So back to the turnaround story. Let's keep in mind the marketing. No, so listen, I think that Victoria's Secret reported today. They told us that November feels up. Like they told us that Black Friday, the weekend was good. And that obviously is a big store business. So I think that what we do, everything I've been seeing, so I generally agree with Jerry that a lot of these numbers we have to take with grains of salt for context, but the people that I'm talking to, what we are seeing, what we're hearing, I think so far, the Black Friday weekend, the holiday has gotten off to a good start. I think the biggest question is going to be less, did it perform now, and more, what's going to happen in the lull? We've got a long time between now and Christmas. So I think that's going to be this interesting dynamic of, did the strength that starts, does it carry through? And when we think about what Victoria's Secret said, they did guide January and December to see a material step down. So that'll be one thing worth watching. But I'm gonna be a little bit more, I think, optimistic and flag that most of consumer just reported, and from what I'm looking at, a little over 50% reported revenue growth, and they all saw fantastic gross margin. So I think it is a little bit more of a case by case, and kind of Jerry went through the winners. And so I think when I look through this, I'm seeing a dichotomy, but it's not as much group agnostic. I'm seeing a lot of pairings. I'm seeing companies like Athleta see revenues down, and we'll see Lulu up, right? You're seeing companies like Coach up and Michael Kors down. They sell the same thing. And that works with the big box as well. And so that works in off price as well. You're watching Nordstrom Rack and Old Navy, you have revenues down. You're seeing PJ Ross Burl be up. So I think right now we're finally in this environment where winners, people who predict their demand well, are going to continue to win. And those that don't are going to lose. That's an interesting retail opportunity. And so that actually makes me a little bit more optimistic.
So neither of you named who you really see as potentially losing in this space. I heard some names of winners. I saw the Victoria's Secret results today. We know that Walmart's been a winner. I haven't heard Target be mentioned as well. Simeon, I want to ask, who do you see as not doing as well in the current retail landscape?
So it's interesting because Jerry framed stock versus company, and I think that matters because I think a lot of the businesses, if we look at the stocks that went up, are not necessarily the ones that the revenues went up. So simply even saying what are the winners and who's losing, the question becomes, what does it mean to lose? Right? I told you Lulu's going to presumably put up a nice revenue number. Is the stock going to be up? We'll see. The stock's at $430, $435. So I think right now we can see whose revenues are down. And so if that's the simple mitigator, then we can just run through those and see that Nordstrom Rack did see a decline in revenues, despite the fact that they're in the off-price category. But I think it is more complicated than that. I think kind of when we think about what's overvalued, where are the expectations? Some people would say that Victoria's Secret is showing a sign of inflection, but a lot of which is because it was perceived to be negative walking into it. So I guess I would throw the question back at you when you're asking me who's losing. Is it just the question of whose revenues are down, or are we thinking about, okay, where's the stock mismatched?
Well, we are actually going to have to leave it there because we've run out of time. And I'm not just saying that, okay? So we're going to have to bookmark our conversation. No, I promise you. I promise I'm not just saying that. We're going to bookmark our conversation for time. But it's great to have both of you with us, Jerry Storch Advisor, CEO, and Simeon Siegel, BMO Capital Markets Managing Director. Thank you both.
Good to see you.
All right, coming up, oil outlook. OPEC plus oil producers agreeing to voluntary output cuts approaching 2 million barrels per day for 2024. We'll tell you how it will impact gas prices. That's after the break.
OPEC Plus finally meeting about oil production after the group delayed last week's scheduled meeting. Members agreed to voluntary output cuts approaching 2 million barrels per day for 2024. Despite that news, oil prices are still low, with analysts concerned that the cuts won't be strictly enforced because they're voluntary. For more on the implications of today's OPEC Plus meeting, we turn to Enverus Senior Associate Josie Mills. Josie, thanks so much for joining us today. And maybe, Josie, I'll just start with the news, your reaction to this headline of what sounds like a significant production cut here, Josie.
Yeah, thank you very much. Well, we definitely expected OPEC to continue to manage the market. You know, we call it this Goldilocks zone that they have kind of between $85 to $100 per barrel Brent, where we think, you know, they're comfortable and like to keep prices. So we expected this cut to happen to keep prices, you know, a little higher than we've seen them at recently, kind of following this decline we've seen over the past few months here.
Josie, go ahead. Sorry, finish your thought.
Oh, no, go ahead.
No, it's okay. You have the floor.
I was just going to say, so we did expect that. And so, you know, it kind of helps prop prices back up into that comfort zone going into 2024 as we, you know, expect to see demand fall off kind of seasonally in between that fourth quarter to first quarter.
And you know,
timeline.
Josie, one of the things that had affected oil prices recently, obviously we saw turbulence when the war between Hamas and Israel started, and we've seen prices kind of cool since then. What are we watching for in terms of any geopolitical issues that could trigger an impact to oil prices?
Definitely. Well, it's kind of what keeps oil interesting is there's always so much volatility depending on what's happening across the world. I think going into the winter, yeah, you're watching for more stability, as you guys highlighted. Going forward, you're watching to see, you know, these cuts come in successfully from OPEC. Likewise, I think on the other hand, you're watching what other countries are doing. I mean, we've seen Brazil really increase production this year. You saw Iran increase production quite a bit based on the lowering of or alleviating of sanctions from the U.S. So I think just following those different agreements and, you know, following how the U.S. government is working to keep energy prices low, whether that's, you know, meetings with Venezuela or meetings with Iran to try and build those relationships to alleviate sanctions there to increase production is really something to keep an eye on.
And Josie, so bottom line for you, I'm looking at Brent here, 82, 85. Where do you see that price headed, let's call it in the near to intermediate term?
Yeah, with these price cuts that have been, or these OPEC cuts that have been implemented, we expect prices to average around $87 throughout 2024. So, you know, probably a little softer in the first half of the year there, and then picking up into the back end to high 80s as demand picks up seasonally into 2024.
Josie, what are we expecting then based on the result of today's meeting for the impact to gas prices?
Yeah, so, you know, we've been watching gasoline prices soften over the past, you know, few weeks here as stocks have really began building. You know, looking at, you know, September to October, they've built about 9 million barrels per day. So quite sizable amount, but also seasonal as you see that demand fall off following the summer driving season. So we definitely expect you'll start to feel more of the pressure at the pump as these cuts kind of roll on in the first quarter of 2024. We expect the prices to be, you know, about $85 per barrel in that first quarter. So as that kind of comes down to the price, you expect a bit of an increase there.
All right. We'll be watching. Josie Mills, thank you so much for joining us today, Josie.
Thank you.
And coming up, shares of Synopsys under pressure as despite reporting better than expected third quarter earnings. Our conversation with the company's incoming CEO is after the break.
Welcome back to Yahoo Finance. I'm Julie Hyman. We're watching shares of Synopsys under pressure despite reporting better than expected third quarter earnings. The chip software design provider also issuing upbeat guidance for the fourth quarter and the full year. Joining me now, Synopsys COO, President, and incoming CEO as of January 1st, Sassine Ghazi. Sassine, it's great to see you again. Thanks so much for taking the time to speak with us.
Hey, Julie, great to see you as well.
So the last time when we spoke, you talked a little bit about the growing demand for AI, which I know played a role once again this quarter, led to revenue growth for you guys, led to that forecast going forward amidst just overall greater chip demand. But I wanted to start by drilling down into that AI demand a little bit. Last time we talked, it was about 10% of your revenue. Where does it stand now, and what more visibility do you have on its trajectory?
Yeah, so if you look at the overall demand for AI, it's still in an early stage of adoption. If you look at the hyperscalers, for example, they're all trying to figure out how do they invest in their own AI chips in order to support their specific workload, specific applications. And of course, companies like NVIDIA, they have plenty of runway in terms of shortage in supply and a significant demand for their chips, with many other companies like AMD and other trying to fill that significant demand opportunity for all the various applications.
And also, even since the end of the last quarter, you guys introduced a new product in cooperation with Microsoft that is AI focused. What are you hearing from your clients in terms of that product and the broader suite of services you're offering?
So today's modern chips that they go into a car or a data center or your PC, et cetera, are so complicated that getting the task done without having some sort of an AI support, and the support, I mean optimizing the chip, getting time to market, reducing the effort required in order to get to the results that our customers are shooting for their product spec. And this is where we come in. We have a number of AI offering that goes with our product in order for our customers to deliver to their customer and product innovation.
One of the things you all talked about on the call, and it sounds like demand is still quite strong. Your backlog is still quite strong, but you did talk about a couple of headwinds. One of them was China, which I want to get to in a minute, but you also talked about a potential headwind from enterprise spending. What does the pace of enterprise spending look like right now, and what do you think it will look like going into next year?
So we have, if you think of Synopsys, we have really three businesses. The first business is design automation, and this is where we serve absolutely the semiconductor market, and that's a software business. The second business is design IP, and this is, again, focused on the semiconductor market. The third business is software security and quality, and there the customer are the large enterprise customers. And as you know, the enterprise spending in 23, enterprise software spending in 23 has softened. And going into 24, it does feel is going to be in the same type of an environment. So as we guided FY24, we guided a strong midpoint growth of 13%, taking into account those two headwind factors, the enterprise software spending staying the way it's been in 23, and the impact of China.
Can you give me a little more color on China specifically? Because, of course, you have the export control issue there that's affecting the semiconductor industry, and you also have the macroeconomic environment there. What kind of signals are you looking for? What kind of clarity do you have on the situation in China? Because it has been one that's been difficult to predict.
Yeah, the macro is what we're all familiar with, their GDP and the spend, et cetera, in 23 and looking toward 24, 25. The other area that we watch very carefully is the export control, both on technology and customers that they enter into the entity list. And those are having an impact because customers that they're looking at their roadmap inside China, they're determining, do they stick to that roadmap or do they pivot to develop a different product for different application, different markets, given the restrictions is not giving them the flexibility to provide a competitive product for those specific markets that they're under export control. We have to take this into account as we're looking at our forecast looking ahead. Now, the reason we guided 13% is we have two amazing tailwinds that they're driving our business, which is the continued increase in silicon demand. We talked about AI earlier. And the other one that we're seeing absolutely happening around us is almost every system company is looking to develop their own silicon in order to differentiate their application and their product differentiation.
Right. That has definitely been a very interesting trend that we've been watching as well. You mentioned your three businesses, right? And the one that's most affected by enterprise spend. It's also one that you're considering options for, including potentially selling that. That's the software integrity business. So how quickly do you think you'll figure that out? Will it indeed be a sale? Are you in talks with other parties already? Where in the process are you?
So I called yesterday as day zero. So today is day one. Because yesterday is when we announced that we're exploring strategic alternatives for that business. I have no doubt that there will be many, many interested parties because for the last, honestly, year and a half, we constantly get pings from interested parties to see is there an openness by Synopsys to collaborate, to sell, to co-invest, etc. Because as you can imagine, software security is a very important area for the future. So security in software and the whole stack, especially given AI, is going to continue as an area of growth and opportunity. The reason we are considering these strategic alternatives, because the 90% of our business, which is the first two businesses, we truly see an insatiable demand for chips as the AI wave and software-defined silicon is in that early stage of growth and opportunity.
Insatiable demand. That's what investors, I suppose, like to hear. Sassine Ghazi of Synopsys, thanks for being with us again.
Thank you, Julie. Great to see you.
Coming up, the closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned.
The month of November coming to a close on Wall Street, and it was a strong performance. Jared Blickery here with the breakdown. Jared.
Hey, thank you. Mixed performance today. Strong performance for the month. Nasdaq down 19 basis points, but for the month to date, we're looking at gains of almost 10%. That's year to date, and we'll just take the 1 month right there. There you go, just a little bit over 10%. And let's take a look inside the sectors. 21 days in the month. Only thing that ended in the red was energy. That's all large cap action. Tech, that's up nearly 13%, followed by real estate, consumer discretionary, and financials. All of those outperforming, all of those up more than 10%. And you really get a feel for what happened when you take a look at the Nasdaq 100, because it's not just the mega caps over on the left side of your screen. It's just about everything, except for energies, as I was talking about. Here we see Tesla up 19%. And if you want to think about some of the fringier parts of the market, they also saw a lot of love. Here's our meme stock board. We got Palantir up 35%, Coinbase up 31% or 61%, excuse me. We haven't talked about Avis in a while. That's up 12%. One of the few things that was actually down, we would talk about probably the 10-year T-note yield and the VIX. VIX going the opposite way of stocks, but as we clock in and head towards the final bell, just want to show you a couple more screens here. We did talk about energy being a little bit of red, and you can see here, that's about the most red you're going to see on your screen this month.
Thanks, Jared. That was the closing bell on Wall Street. Let's do a quick check of the markets as another day of trading comes to a close here. It is a mixed session here. If you look at the indexes, the Dow is shooting higher here. Late day surge. It's going to finish about 1.5%, about 536 points. Of course, we did get some economic data today showing cooling inflation. You also saw certain names helping out the Dow as well, like Salesforce. They reported, investors like what they saw and piled in. The S&P 500 is also going to end the day here in the green, up about 0.4%. The Nasdaq, though, a different story. That is going to end the day in the red, down about 0.2%, Diane.
All right, let's take a look at some trending tickers. We want to start with Occidental Petroleum. That stock is actually falling just shy of 2%. This on some M&A rumors. The Wall Street Journal reporting it is in the running to buy shale driller Crown Rock. Now, a deal for this closely held company, it could be valued above $10 billion. That would include debt. We know within this sector, oil and gas producers have faced pressure to kind of scale by doing deals. We had earlier this year Chevron buying Hess. Before that, that was ExxonMobil doing that $60 billion deal to buy Pioneer Natural Resources. So there's a space for these players to try to get bigger through acquisition, Josh.
Yep, certainly. So you look at this player in particular when you talk about Crown Rock, big private oil and gas producer in the Permian Basin, North America's, of course, big source of crude there. And really just the latest deal in this sector, as you were sort of suggesting there, Diane. I mean, oil companies, they got a lot of cash, and they have been putting that to work. I mean, Exxon's $60 billion deal for Pioneer, Chevron, of course, the $53 billion takeover of Hess. So we've seen some real headline-making deal activity in this space.
Yeah, indeed, and we know Occidental is favored by Warren Buffett, so it's got a legendary investor behind that company. And Crown Rock they produce about 150,000 barrels of oil a day, so they certainly have some strength in their wheelhouse there.
All right, moving on here. Let's check out Ford. It was falling today after the auto giant lowered its profit guidance due to labor costs after signing a deal with the UAW. So this one, this is about the financial guidance, bottom line. They lowered their profit guidance. It's going to come in lower, it seems, Dan, than what they had predicted because of those labor costs. So that new contract, of course, with the UAW. So now Ford says they're going to be looking for 2023 adjusted earnings before interest and taxes. They're shooting for between 10 and 10.5 billion. It had been estimated at between 11 and 12 billion.
Yeah, that's right. That's right. I mean, and the forecast they're saying it also includes about 1.7 billion in lost profit. That's from the strike. They're estimating that's going to impact vehicle sales as well, leading to about 100,000 units fewer wholesale vehicle sales. So Ford's certainly following in the footsteps of GM and in terms of their forecast as well. And we knew that strike was going to have an impact on production, on the numbers for both of these for several car makers in general. And we know that it was a tense negotiation process with the unions, and the car makers had to put a lot on the table to get this deal across the line. And so we know that's also going to add about $900 in labor costs per vehicle by 2028. That's what Ford's saying. Ford say is working to offset those costs by making cuts elsewhere. And we want to look at another player in the vehicle space, this time in the EV space. VinFast shares are rallying today, jumping more than 11% after the company announced it will showcase its latest model, the VF9 EV, at the COP28 climate conference. So it's getting some action today. It's been really volatile stock since it went public through a special purpose acquisition company earlier this year. That was back in August. I mean, they saw as high as $82 a share at its peak. And at that time, this was wild. I remember us covering that. And at the time, it was like the third most valuable car company, which was wild. I mean, for this new public debut company. They lost money in 2021, then pivoted to EVs, and that's where they are now.
Yeah, I mean, this stock is, it can be very volatile. I mean, the broader story to me, Diane, that's so interesting is just when you look at this EV market right now and how consumer demand does seem to be waning. You're watching these EV makers slashing prices. They're putting off billions in EV-related investment. I just wondered, did investors maybe get a little too ambitious and aggressive when they kind of mapped out and thought about what EV adoption was really going to look like?
Yeah.
Because it does look like there is a kind of adjustment going on here.
And I mean, that's been the concern across the country, just about the infrastructure behind wider EV adoption just really isn't there yet with regard to the electric vehicle space. One thing I also want to note in terms of coverage of VinFast, only a couple of analysts have initiated coverage. One of them, friend of show, Dan Ives, who's initiated coverage with an outperform rating recently and a $12 price target. So in terms of its gain today, it's still got some room to get there with regard to what Dan Ives is looking for. He sees this, just both the growth of it being an international player, and that's where he sees some strength for the company, although its home base is obviously in Vietnam.
Got it. All right, moving on. Tesla's Cybertruck. It's finally here. The company's Cybertruck delivery event just wrapping up in Austin, Texas. Here's Elon Musk from the start of the event.
We have a car here that experts said was impossible, that experts said would never be made. That it really is the most. I think it's our best product. I think it's the most unique thing on the road. And finally, the future will look like the future.
Joining us now is Barron's senior writer Al Root. Al, it's great to see you. I was talking to Diane earlier in the show, and I was telling her I really don't think, Al, I've ever come across a vehicle that elicits the kind of emotional response that this truck does. I don't know if that's the truck or Elon Musk. Maybe it's a bit of both, Al. Give me your take on the truck. What you're seeing today and what you think, Al, ultimately demand is going to look like for the Cybertruck.
So I think you're right. I think it's a combination of everything. It's definitely the look, right? It is. He's right. It's unlike anything you're going to see on the road, whether it's good or bad. Who knows? It'll be good to some extent because there's always a niche for some people that want to be a little different. The question is, can this be sort of a mass market product? Can this be sort of the turning point in automotive design that Elon probably would like it to be? The interesting thing for Tesla is we're not going to know for a long period of time. Tesla's already set up the fact that this is incredibly difficult to build. You talk about volumes. Wall Street expects about 1,500 of these to be delivered this year, 78,000 next year. Tesla itself says we can't get to producing 250,000 a year on a run rate basis till at least 2025. So that's like December 25, they can make 40,000 of these a month. Now, it's really interesting because the pre-orders for these things, there's like 1 million pre-orders, but you only had to put $100 down. It was fully refundable to get on the list. So we just don't know what demand will be like. The market has sort of moved off this idea that, this will drive margins and sales for Tesla. And now we're hoping that it's sort of like so cool that it drives this halo effect and it'll end up selling more, Model 3 and Ys.
So speaking of just the audience for this, and again, you gave numbers about the 1 million people who have put down this deposit. Yes, it was a cheap deposit, so there's, low skin in the game in terms of your commitment to this. Can this compete with an F-150 or Ram?
That is, so what do I think? I tend to be too in the weeds on cars and too rational, right? So I think features and benefits ultimately win. So if this has leading towing and leading range and features that excite people from a truck perspective, then yes, I think it will win its version of market share. Now that's to be seen. We talked to Ford and we talked to General Motors. General Motors today said to me, "Listen, we feel very comfortable that our electric Silverado will stack up very well, and that people will prefer that form factor to the Tesla." So they'll battle it out, and that's to be seen. Now, one thing I would say is I do think that sort of that performance luxury car buyer will consider a Cybertruck. The Cyber Beast model starts at $100,000. That's not really a truck. That's sort of a luxury car, sort of thing. I don't have $100,000, but if I did, sure, I would test drive this one as well. So I'm not dodging the question, but there will be a segment of people that treat this like a sports car, and then we're going to have to see if this will end up in fleets doing real work of American trucks.
One of the issues with regard to the EV space, Al, has been range and why there is not wider adoption of electric vehicles. I just saw someone tweeting saying, the range of the Cybertruck, it's not worth it. What's your take on range and the value and the potential buy-in for the Cybertruck?
So I would agree. So the price, people were hoping from a range of like 50 to 80,000 for all the trim levels. People are hoping to see maybe a max of 500 miles of range because especially when you're towing in an EV, that saps range quite significantly when you're pulling a trailer, something like that. So 500 miles is a little better than like a sedan, which typically comes at 250 or 300. So I would call, I'm going to get emails on this, I would call the range and the price slightly disappointing. So that's not as good as I would have hoped. Now, in terms of adoption of the truck, I'm going to dodge the question again. For a couple of years, no matter how many of these get delivered, Tesla will declare victory because I think there is enough people in that sort of unique want a Tesla. They could ship 100, 1,000 of these, no problem. And then they can say, look, we went from 1,500 to 200,000. We still got all these orders. Great. But you asked the right question. Is this enough range to see this penetrate the truck business in a more substantial way? Ford, if you look back at the beginning of the year before we ran into some EV hiccups, wanted perhaps 10% of their total F-150 sales to be F-150 Lightnings. They won't come even close to that. Now, some of it's production problems, but some of it might be those features and benefits you're hinting at.
And Al, I want to get you out of here on this, and it is a subject you kind of touched on earlier. This idea of the halo effect, Al, that the truck could kind of reinvigorate a brand that some argue at least has lost a bit of shine because of the lack of new models. One, I'm just interested, Al, do you buy that? And secondly, do you think it could sort of help kind of motivate sales of other models, the Model 3s and Ys?
So, there are pluses and minuses to everything you said. So in the car business, I do cars all the time. They have halo cars. They all do. The Corvette's a halo car. The Cadillac Celestiq, which is this 300,000 EV that they're launching, they're hoping that accrues to the brand. So that's actually a thing. So to some extent, we can buy that story. How much it will boost 3 and Y sales, that is to be determined. I do think it can help. Now, Tesla has recently been saying on a corporate level, like we're in a slightly slower period of growth, right? They're going to do about 1.8 million units this year. Wall Street believes they can do about 2.2 million units next year. Can they do 2.2 million? Yes, but ultimately, halos exist. But what they really need is sort of a lower price sedan, a la some of the EVs that are being sold in China. That opens up sort of a different market for them, not one that people want $100,000 cars, but people who are interested in EVs, but are looking in that $25,000, $35,000 range. That is what will drive sales growth materially in 25, 26, 27 for Tesla. And we have yet to see that car.
All right, Al Root, Barron's, we will have to leave it there. Thank you so much for the insight on the Cybertruck. We appreciate your time.
Thanks.
Right, coming up, shares of Ulta are in focus. That stock has been trading higher in after hours after reporting Q3 results. We'll dig into the numbers. That is on the other side of the break.
Shares of Ulta are trading sharply higher here in the after hours after reporting results. Let's get you those numbers. Q3 results, they reported EPS of $5.07. That was versus an estimate of $5. Net sales come in at $2.49 billion. That was up about 6%. Versus an estimate of $2.47 billion. So those are beats on the bottom and the top. Looking ahead for the full year, the 2024 full year forecast, it looks like they narrow their EPS forecast for the full year here. They now see EPS $25.20 to $25.60. They see net sales of $11.1 to $11.15 billion, and they see comparable sales here. Their estimate is calling for 5 to 5.5%. And at least initially here, Diane, investors clearly like what they see.
They do, absolutely. I mean, it's a solid report. When you think about how they were positioned coming into this, there had been some downgrades in terms of the view of how Ulta was going to perform because they had cautioned in their last quarterly report report. They're saying in their, in terms of their earnings release, that it was a strong performance. You saw sales, gross profit, diluted EPS all exceeding their internal expectations. Again, they had caution on their last quarterly report. Traffic remains healthy, brand awareness increase. The outlook for beauty has been doing well, and we've talked about the beauty component in terms of some of the retail sales results that we've had recently that has held up, even in the face of some consumers kind of pulling back in other areas. You go back to that kind of lipstick indicator effect. People will still splurge on those little things that make them feel better. So they certainly did better. You had Citi coming into this, lowering their expectations. They were expecting 492. Telsey Advisory Group, boutique firm, also had a similar outlook. So not surprised to see this reaction in terms of the share price right now, up after hours, about 9%. We'll see how it does. It performs tomorrow when the market is open.
Sure will.
All right. It was a year ago today that ChatGPT made its debut. Now it's the fastest growing service ever, with its parent company OpenAI boasting some 100 million weekly users and 80% of Fortune 500 companies registering accounts. We're looking into how generative AI technology has become mainstream and where it is going next. Joining us now is Mandy Long, the CEO of Big Bear AI, which harnesses AI to solve complicated analytical and logistics issues for the federal government and big business. So let's kind of get into this here with this anniversary that we've looked at. A year ago, we were at the forefront of hearing this kind of technology, more about it. You're in this space, though. So now, where we are now, one, are you surprised by how fast the adoption has been, especially when you think about generative AI?
First of all, thank you for having me. It is a fascinating day, and I think happy birthday to ChatGPT is very fair to say. You're right that the rate and pace of innovation of this kind of technology has no historical precedent. We see that. I'm a longtime technologist. I've lived in this space and worked at several organizations where we've made material investments in AI. And I think what we've learned from the last year is two things. One is that we are unequivocally in the midst of the fourth industrial revolution. And two, AI is the new literacy, right? What we saw OpenAI accomplish in democratizing the availability and interaction model of AI for the average person is remarkable, right? It's changed the paradigm for interacting with technology that was previously only available to someone who understood data science.
And Mandy, I got to ask you on this day as well, though, about OpenAI, the drama there, Mandy. Sam Altman is back. You're in this industry. I'm just interested on your take of what happened there, Mandy. And also interested, do you think OpenAI did that news, did all that drama, did it deal that company a blow reputationally?
You know, I think what I take away from that, and it's a question that I think many have asked, and I think very few have answers to. But what I see representing the technical community is that it's the first representation that I think many of us have seen where the developer, right, the technical contributor, had a voice that changed the outcome and changed it very quickly. And when we look at the dynamic of how technical talent is playing a role in the development and evolution of complex businesses, I think what we can learn from what's happened in recent history is that the developer has a voice now more than ever, and we're going to see it move companies.
And Mandy, speaking of moving companies, I was having a chat with my sisters about this whole, the big issues with Altman, in, out, back in, again. What does it do for a business like yours? Does this, it's very chaotic to people watching this. Does it draw more interest, or does it make people skittish when it comes to what you all do?
So we work in many ways in a parallel community, because most of what Big Bear AI is focused on is complex decision-making for the national security mission, right? We provide very specific mission-oriented applications of AI, as well as other advanced technologies, to an operating environment. And most of the questions that we get, right, and what we've seen from our customer base, as well as just from the market more broadly that we service, is that there's a question of how this technology is getting applied in an enterprise format. And from our vantage point, LLMs, right, and the use of generative AI is a tool, right, in the toolbox of a technologist when applying it to use cases in the field, and that will continue to be the case.
And Mandy, you mentioned your company, your technology, your customers. How does business look right now, Mandy, as we roll into 2024? How fast are you guys growing?
We are in one of the fastest growing markets that exists right now, right? We do service in supply chain and logistics, cybersecurity, and autonomous systems. I think you'd be hard pressed to find a couple of segments that have more happening as it relates to the adoption of these advanced capabilities than those that we service. So I'm bullish, right, on where we're headed. We've done a lot of hard work over the last year to stabilize the organization and position ourselves to capitalize on that growth. 2024 is going to be a great year for us.
And then let me ask you, Mandy, about the kind of structure or guardrails around this type of AI, around generative AI. When you think about, say, ChatGPT and other chatbots, we give them so much information, right? And there's not really regulation around this. Yeah, again, I think about like a conversation with one of my sisters where she talked about doing some research. So she works as a professor, but it brought into the conversation, and it's not supposed to happen, something, a private question that she'd asked previously. And she's like, hang on a second, that's not supposed, these are supposed to be separate and apart kind of conversations. What are we sacrificing in terms of privacy when you think about this space of generative AI, LLMs, and the progress that is happening when you balance that out with privacy?
That's a complex question, because I think a lot of what we've seen with social media in general, right, as it relates to privacy, is that, you know, as humans and as participants in those platforms, we put an incredible amount of personal information out in the public forum. And I think we're learning about the long-term ramifications of that over time, right, as we raise our kids and we try to teach them about the idea of permanence, right, in an online format. When you think about regulation of technology like this, and you know, you look at, for example, the executive order that came out on October 30th, there is an incredibly appropriate amount of focus on figuring out how we're going to, on an ongoing and continuous basis, put checks in place. And that's the piece that I would focus on, is what has worked historically for regulating and providing oversight of advanced technologies is not going to work here, right? I've talked previously about the idea of tech regulating tech. I do not mean that in terms of tech companies, right? I mean it in terms of core technology, helping to regulate and provide oversight of these capabilities, because it has to happen at the speed of cyber.
Mandy Long, thank you so much for joining us today, Mandy. We appreciate that time and insight.
Thank you for having me.
And coming up, Meta's VR headsets have a sweat problem. We're going to explain that after the break.
Hello and welcome to Yahoo Finance's group chat. I'm Alexandra Canal, joined now by Brooke DePalma and Josh Schaefer. Today we are starting with the woman who seems to be putting out PR fires everywhere, ex-CEO Linda Yaccarino, once again trying to clean up after her boss Elon Musk told advertisers to get lost if they don't like the way he does things. And that's putting it very kindly. He was very explicit in that interview with the New York Times yesterday. And basically he said, if you do not want to advertise with us, we don't care. And it sends a very complicated message because he also admitted that if advertisers were to pull away from the platform, that X would not survive. So Linda Yaccarino certainly doing some damage control here. She wrote in her own post in part saying, here's my perspective when it comes to advertising. X is standing at a unique and amazing intersection of free speech and Main Street, and the X community is powerful. They're here to welcome you, to our partners. We believe in your meaningful work. So I just don't know if that's enough.
How are you gonna make money without advertisers, Elon?
And some of those that have already pulled out, we've seen Disney, IBM, Apple, Comcast, Lionsgate, Paramount, these big names that have since boycotted advertising on X.
And so we were talking about this as far as advertisers being X's quote unquote customers, right? Like they're who help X make money.
Yeah.
But he's also done this to the literal users of X too, right? When you think about how Elon has interacted since it was previously named Twitter with people since he took over the platform, he's rather combative, I think, with a lot of the people that he converses with on there. He's been combative with journalists. Journalists are a big part of what happens on X as far as people that use X.
Right.
All of us use X, right? And we're a portion of users on X. He took away the blue check mark, sort of muddled that, threw off a lot of people's feeds in a way people didn't like. Your lists are different now. You don't have TweetDeck unless you have Twitter Blue or X
Josh
Blue.
just listing everything that's different now.
The platform is
Yeah, it's
inarguably
different.
worse a year later. And so I think it's not just about the advertiser thing is bad, but you're also now, you're sort of telling everyone that you make money off of, whether it be the consumer of the platform or the people that advertise on it, that you don't care about them. So I don't really know.
Don't care about their opinions.
So like, what are you going to do with the
whether or not they
business? I don't
enjoy
really
it.
get it.
Yeah, a little bit different to Gary. I mean, you have to admire Yaccarino for really standing by Elon Musk. She just joined in July, and I feel like she has been met by a multitude of challenges, a very tough spot, but she continues to stand by his side. And there's so many that have such high respect for her in the industry. And of course, she has to care about what sort of message she's putting out there, what sort of message she's sending the community that quite literally built her. She was the head of advertising at Comcast, I believe, and she has such a high respect. And so I'm very curious to get inside of her head and where she wants to be and her legacy that she wants to leave behind in this community that helped bring her to where she is.
Yeah, what's going on behind the scenes with her and Elon Musk too, because it brings me back to thinking about how a lot of these leaders, these CEOs, they give these media interviews and they have these conversations, and it seems like a comment is off the cuff, but there's major ramifications there. It affects the stock price if you're a public company. It affects, potential advertisers.
Oh, imagine if Twitter was still public.
Oh, could you imagine?
Yeah.
That would be crazy to see the stock reaction after that. So it's one of those things where these executives, what you say matters, carries weight, and there's an impact that goes
And she did call this a wide-ranging and candid interview, which we know Elon Musk always gives wherever he goes.
What's on his mind.
So she did preface it in that way, and I, just can't emphasize enough what is going to happen from here. Where does X go from here? Who will they look to bring on? Will they start thinking of maybe small players in the game who are willing to, or maybe not willing to take the risk of advertising their platform since these big names have pulled out? Who are they going to look to next? Yeah,
that's a big question.
We have a lot of questions on this. But if you bought something in the recent sales buzz and now want to return it, you may be surprised to find the seller telling you to keep it as more and more retailers jump on the return less trend. And we're seeing, this is not something that's new, but we're just seeing more retailers really say, hey, actually, you know what? I know that you said you're going to return it, but you can actually keep it. We're seeing Walmart, we're seeing Amazon, Keurig, Wayfair, just some of those to say this. And it really is a profit play. And it also, maybe keeps the consumers wanting to buy more. We know that cumbersome return process can be a lot for consumers sometimes.
Yeah, I mean, not having to return things is nice, right? If you order something like that and you get to keep it, I mean, from a consumer standpoint, it feels kind of great.
I mean, only if I could exchange it for store credit, or because if I bought something and it doesn't fit me and I want to return it, and they're literally saying,
well, sometimes they'll give you back the money and they'll just say, just keep it. And then others encourage you to sometimes donate it, to use it for something else. But really what we're seeing here is this e-commerce boom that's really leading retailers to have to rethink the way they're accepting returns. I mean, we saw an epic Cyber Monday, over $12 billion in sales. Just think about how many returns that will lead to.
Well, and it sort of tells you about some of the products people are buying online now too, right? Especially when you think about Amazon. Like, you buy like Windex on Amazon now. Like, you buy normal things that yes, you're not gonna return because you're buying things that are like less than $10.
Right.
So that part of it makes sense.
In most cases, they do accept their returns, though. So this is like a case-by-case basis.
Yeah.
They're not saying everything you can return. But for those small cost items, that really doesn't make sense.
It does make sense, too, because the typical return cost retailers have is about $30, according to data. So if you bought a shirt, that's less than that, and it's going to cost the retailer more to ship that back, they're taking a loss there. On top of that, if you have inventory issues, that's a whole other, conversation.
Right.
So to me, this does make sense from the retailer perspective, and I think from the consumer perspective as well. You just want to make sure they're not abusing the system.
Exactly.
It's that double-edged sword.
Yeah.
I got to move on to my story because I'm excited.
Okay, we're all right.
This is something you cannot return.
With
this is something you cannot return if you're sweating it, right? So they say not to sweat the small stuff, but it's becoming quite a big deal for Meta. Meta's headsets, this stems from a newsletter from Bloomberg today, essentially saying that Meta is struggling with some of their headset sales because of people sweating in the store. So then people don't want to try on the headset and therefore don't buy the headset because they never try it on. Interesting to think about. I just hadn't really thought. It kind of makes sense. You put the headset on in the store, and I guess you're sweaty.
Makeup gets on it.
Yeah, I mean, it makes me not want to try it on now, right? After reading that.
Yeah, and the price points are pretty high on these, so I would like to try it. It actually reminded me of when we used to be popular, right? So you go to a friend's house and then you try it and then you want to buy it.
Right.
So, but I feel like we're not at that point yet where enough people have virtual reality headsets to make me want to go out and buy one.
You definitely have to try it. You have to see what it looks like.
Mark Zuckerberg has said that. You have to experience the virtual reality to really want this. And obviously,
be willing to pay for it,
Exactly. And this comes at a not so great time, too, because we have Apple's Vision Pro coming out soon, so that's going to create a lot of competition for Meta. But this reminds me of back in the day when I used to play lacrosse, and you had your little guards.
Would you use somebody else's?
No, and I would break out after putting that on my face. So I understand why people are hesitant. I mean, people are willing to pick up phones other people have. They're willing to try on clothes that other people have tried on.
Not AirPods.
But when it comes to your face or like any of those
extremities,
areas,
you should add sanitizing wipes, though, right?
No, but they were apparently. They had Meta employees wiping things down, and people were still a little icky, and especially in this post-COVID world too.
All right, if you have a sanitizing wipe, I'm sorry. At that point, it's clean. Right? Isn't that how sanitizing wipes work?
I don't know. Once I see a little bit of makeup on it, I'm like, oh.
If I see someone sweating,
well, no. If you look at the headset and it's dirty, then sure. But if it just you can't tell and you wipe it with the sanitizing wipe.
If I really wanted to try it.
The headsets are pretty cool. Have you guys used them?
I have used it.
I actually haven't.
And I actually got whiplash because I
Oh boy.
Well, yeah,
another time, another story.
Not just because I'm clumsy, not because of the actual headset. So there's that.
All right. I guess we got to go try those out again because I don't think that's supposed to happen. But coming up, we're gonna have more Yahoo Finance Live on the other side of this break. Stay with us.
The holiday season is upon us, and millions of Americans are shopping in person or online for gifts. From Thanksgiving Day to Cyber Monday, some 31% of consumers bought toys, according to a National Retail Federation survey. But a big issue for consumers this year is inflation and how rising prices impact discretionary spending. Here with more is Ali Mrjeski, editor-in-chief at the Toy Insider. So, Ali, thank you so much for joining us. Sorry about I worked on your name ahead of this.
You did a great job. It was so good.
All right, so let's talk about kind of the state of the toy industry today. We led into this talking about how inflation is biting into consumers' wallets and where they can spend. Where are you seeing that in terms of the impact on toys? And I know we have some toys here. We'll get into what's hot and what's not next, but go ahead.
But the industry overall, we're using 2019 really as a benchmark this year because the pandemic really skewed 2020 through even up to the third quarter of 2022. So we were seeing a lot of people were staying at home. They were buying a lot of things for their kids to do to keep them busy and things like that. The toy industry boomed. But looking at 2019, the numbers are still up over 2019. So that's awesome. So it may be down year over year for 2022, but based on that older benchmark pre-pandemic, we're really looking at a good year coming up.
Okay, and so now we have looked at, the toy industry had some inventory issues like many other industries within we had all kinds of supply and inventory issues. There was an undersupply, then there was an oversupply. Where are we now with regard to inventory?
So I think this holiday season is really, we're rebalancing. We're resetting, everything's getting back to where it should be, back in place. We are looking at some of the hotter toys for 2023. We're actually delayed a little bit because the retailers were trying to get that old product that was overstocked off their shelves, which was also pretty big for discount retailers like TJ Maxx and Big Lots and things like that because they were getting all of that overflow. So it really actually opened up a lot more places to buy toys, I think.
So what's hot this year?
So what's hot this year? What's great is that everybody's on a budget this year, right? Everything here is under $30, so that's amazing. We have games that are super popular. This is pigs on trampolines, which is so fun. You can bounce those pigs.
Okay.
Yeah, comes with 3 trampolines. You have to try to bounce your pigs in there. We have some plush toys like the Pudgy Penguins plush buddies and Bum Bums from Jazzwares. These are both under $20. They're collectible plush and different characters. We have some retro toys coming back like Strawberry Shortcake and Rainbow Bright collectibles, a Light Bright that is all touch instead of pegs, which is amazing, and even some interactive pets like Bitsy from Spin Master, which is it's $30, and you have this cute pet that you can interact with that kids are absolutely going to love.
So then let's talk about what 2024 looks like for the toy industry. You mentioned some, resurgence of some oldies but goodies. The Strawberry Shortcake, I remember that. My sister loved the Strawberry Shortcake, or the Strawberry Shortcake and affiliates, I should say. Tamagotchi, I know, had made a comeback.
Yes.
So what does 2024 look like for the toy space?
I think that, the toy industry is like the fashion industry, right? It's following those trends that are popular in the same kind of way, and we're really getting a throwback to the 90s and early 2000s there. I think the same thing's happening in the toy industry, but it's all getting upgraded a little bit for today's kids.
And then what are you hearing from retailers? Are you hearing any caution from, say, like a Mattel or Hasbro or Jax, et cetera?
Yeah, well, they were all expecting a much softer holiday season this year, just based on informal numbers coming out of October. But I think that, Black Friday and Cyber Monday numbers really surprised the industry a lot. So a lot to look forward to for the holidays.
And then how does the toy industry compete with electronics? For instance, I notice that kids younger and younger are not playing as much with toys like this at a younger age compared to, say, back in the 90s or early 2000s. I know that as a mom myself.
Yeah, and I think that really parents and grown-ups are the ones with the buying power, right? So I think that they're actually looking for ways to get kids away from those iPads, to put down those screens for a little bit, or even to integrate it into playtime. So I think that toy companies are really working to have screen-free play, but also tech toys that are really integrated with the way that kids, the tech is so second nature to them now. So.
Yeah, I got to figure out a way to get my kid off his iPad. Maybe more Legos are in order this year. All right, Ali Mrjeski, Toy Insider Editor-in-Chief. We appreciate your time today. Thanks so much.
Thank you.
All right, you got it. Coming up, what to watch tomorrow. We break down the stories you need to know to start your day. Stay with us.
Lyft making its way toward bolstering its bottom line as ride growth accelerates each quarter so far this year. Stock seeing gains of about 6% year to date. However, amid the fierce competition in the ride-sharing space, where's Lyft's destination headed to next? Joining me now is Lyft CEO David Risher. David, thank you for being here.
It's great to be here, Josh.
I thought that we just would start kind of high level. So, you take the reins early this year, you get to work, cost cutting, it's a focus on innovation, new features. As we roll into 2024, David, what is ahead for Lyft? And all the investors who are watching right now, why should they be excited about Lyft's story?
Yeah, so our focus and our thesis is customer obsession drives profitable growth. So you're going to hear me talk about customers over and over again. We have riders and drivers. We just launched something called an online pickup promise. For example, if we are late to pick you up for the airport, we will literally pay you up to $100. And that's enough to actually get an Uber if you actually need it. So it's that sort of innovation really focused on what customers want that's going to drive our growth and our profitability.
Let me ask some questions too, Dave. I know top of mind for investors. One is market share. Where's that stand right now, David? And do you see where you stand right now as stable?
So, I mean, the truth is, I'll start with this. I actually don't obsess over market share. I obsess over customers. Now, I look at market share, and I look at it as an indication of whether our riders and our drivers are responding. Right now, it bounces around maybe 30, 31, 32, 33%, something like that. Depends a little on the market. When I started, I think it was around 27. But what I'm really excited about is how much riders and drivers are responding to what we're doing. We just launched Women Plus Connect, which lets riders and drivers who are women connect to each other. That's the sort of stuff which drives share up, because if you're a woman and want to drive with a driver, you've only got one choice. That's Lyft.
Got it. Let me ask you another issue, profitability.
Yeah.
It looks like Uber now firmly profitable. I think investors, David, want to know, when does Lyft hit that milestone? When do you think you hit that bogey? And I'm also interested just to get your take on long term, what do you think the margins for this business look like?
Yeah. So on profitability, we haven't said publicly yet when that's going to happen. It clearly is a focus. Any successful company has to be profitable. I was just listening to Elon Musk yesterday, and he had an interesting point at the end where he says, look, I sometimes get timing wrong, but I deliver. And that's the way we want to be. We want to deliver. And then we'll tell you about obviously when it's going to happen, when we're ready. You asked another question, I forget.
Long-term margins. How do you think about that?
Yeah, so here's how I think about it. I mean, if you think about it, we have a base product, kind of the Lyft classic product. We pick you up on time, we drop you off on time, we pay drivers well for that product. And the margin there kind of is what it is. I'll just sort of say it that way, like kind of we're where we think we're going to be longer term. What I think starts to grow that margin, though, are when we can get customers to trade up. For example, Extra Comfort is a new product we have if you want to have a little bit more comfortable ride. Newer car, quieter car. That's a little bit higher margin. Our Lyft Media business, which we're just in the early days for. I mean, think of all the different restaurants you go to. Think of all the different ways you interact with other businesses while you're in a Lyft. That's a big business for us, but it's now it could be a $500 million business someday. So I think that's what's going to drive our margins up.
Let's also talk about the competition and competitive advantages. If I was to ask Uber, what do you think their competitive advantages are? They might say, David, scale, food delivery. They probably mention their international footprint. If I put that question to you, when you think about it, what are Lyft's competitive advantages?
So I think focus is a huge advantage. There, you just said three different things. You talked about international. We're really North America focused. You talk about food delivery. We're not interested in bringing stuff to you. We're interested in actually getting our riders out of the house and living their best lives that way. We're 100% focused on rideshare. And I think it's a huge deal. I think how it shows up for riders are things like this guarantee or this promise to pick you up on time, are things like Women Plus Connect. The reason we got there first is because we're obsessing more over our riders and drivers.
Got it. I was talking to a financial analyst, covers Lyft, David, and he's been in the game a long time, smart guy, and we were talking about Lyft, and he said to me, even as someone who covers Lyft, right, he said, I'm not sure what Lyft's future is. And here's how he put it to me. He said, I don't know truthfully whether Lyft looking ahead remains this, independent public company, or he says, do they have to actually merge with another company, like a DoorDash he brought up, and kind of compete with Uber that way. How do you answer that question?
Yeah, look, you never say never about those sorts of things, right? Maybe, but that's not the focus. And listen, I'll tell you why. I think that delivering food to if you talk to drivers, for example, and people who do things like DoorDash or even Uber Eats, they tell you, gosh, I don't get paid as much as rideshare. I have to leave my car. I get a ticket sometimes with the restaurant. The restaurant is a little frustrated with me because now, their margins are sort of getting squeezed. The end user customer is a little frustrated because their food's sometimes a little cold there. I'm not saying it's a bad experience, but I'm saying it's not necessarily an experience that I think is the best for our riders. And we're really focused on that.
Yeah, I'm also always worried when I order that the driver's going to put his hand into my bag. I don't know. Is that right? It's just a thought.
Now that you bring it up, I think that's something we should all think about.
Let me ask you too about something else. Robo-taxis. Yeah. I'm interested here. Obviously, a lot of time and money and effort being put into that technology. Yeah. Big claims being made. Mm-hmm. When you think about that tech, David, not a year out, but long term, does that pose a potential risk to Lyft looking ahead? How do you think about that?
Yeah, I think it's an opportunity, and I'll tell you why. I think automated self-driving cars are going to come. And some people tell you 2 to 3 years, some people say 3 to 5 years, some people say 5 to 10. Almost doesn't matter. It's going to happen. So then the question becomes, what are we going to do about it? And the answer is, we're going to invite them, incorporate them into our network. I mean, look, we give 600 to 700 million rides a year. Those services right now give tens of thousands of rides a month. The scale is completely different. Once we get to the point where you're talking about millions of riders and millions of cars moving around in real time 24 hours a day, if you're a company that's in the business of creating a self-driving car, you want to partner with a Lyft because we're going to be the network that's going to distribute you and frankly pay back the billions of dollars you spent in R&D. So that's how I think about it.
And Dave, I want to get you out of here on this, kind of a personal question, because your biography is interesting. Correct me if I'm wrong, but right before Lyft, you were actually at a nonprofit, David, and as I read about it, it was about delivering ebooks to kids, making ebooks available to kids. What did you, at a nonprofit, what did you learn there that you put to work now at Lyft as you steer and lead this company?
So I love that question, and I'll give you 2 answers. The first one is, in a nonprofit, you're trying to deal with some of the world's biggest problems. In this case, getting kids to read. That was the problem. We got 21 million kids to read, and our budget was $10 million a year. So what does that tell you? That tells you that nonprofits have to solve huge problems with limited resources. That's helpful in any business, number one. And number 2, leading with purpose. So our purpose at Lyft for drivers, help them make more money. For riders, get them out and about, help them live their best lives at airports, at kids' soccer games, going to see their parents, all the rest. And leading with that kind of purpose, I think, really helps you, frankly, do things that it's very difficult to do if all you're thinking about is just how to maximize profits. We want to build a great, profitable business, but I want to do it with purpose.
All right, David, thank you so much for your time today, for that insight. I really appreciate it.
Yeah, thanks. Yeah, it was a pleasure.
Thank you.
Of course.
Thank you.
Keep your hands out of the bag, though.
All right, Tesla's long-awaited Cybertruck has finally arrived, and the first buyers are getting the keys after 2 years of production delays.
So these are the actual owners. We're handing over production Cybertrucks to their actual owners. Thank you for buying Cybertruck.
There are 2 models of the trucks, and they'll set you back between $60,000 and $100,000. That $100,000 mark that's for the Cyber Beast.
Love that name.
Yes.
Love it.
Okay, so I will give some credit there because I was in the camp where I was like, this is too much, this is ridiculous. So we have a note also from Dan Ives already out on with initial thoughts on the Cybertruck launch, saying that the pricing was in line with expectations. I was a little surprised, though, that the low end was not a little bit lower. I will say that.
Yeah, I think what analysts are already crunching the numbers, and I think what they've concluded is it's not going to financially move the needle, at least in the near term. I do think it's interesting, this idea of a halo effect that doesn't help reinvigorate a brand that some said had lost, some shine because of the lack of new models.
Well, we will certainly watch and see what the demand is like for the Cybertruck.
All right, time now for What to Watch. Friday, starting with the Fed. We're going to be watching remarks from a few Fed officials, including Fed Chair Jerome Powell, Chicago Fed President Austin Goolsbee, and Fed Vice Chair of Supervision Michael Barr. Over to the economy, we're going to get some insight on the overall health of the economy from new S&P Global Manufacturing PMI numbers. Last month, manufacturing PMI dropped to 49.4, but is expected to get a bump to 49.6 for November. And some more on manufacturing. ISM data is set to release with forecasts indicating an increase to 47.7%, snapping a 12-month streak of declines. Numbers contracted to 46.7%, remember, back in October. And lastly, new monthly construction spending numbers for October from the Census Bureau. Estimates project a 0.3% increase compared to the previous month's 0.4% increase.
All right, that will do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern Time for all of your coverage leading up to and after the closing bell.